It is that time of week. We are joined by none other than Sam Rule and Dylan LeClair, gentlemen from the BM Pro team. How goes it?
Yo, Q, I think you're muted in spaces there. But doing good, chilling. More craziness today. I think we're going to probably be focused on the focus of our last probably 2 weeks here. The contagion in the industry, from lending desks to hedge funds to all the like. I don't know if we've seen the end of it. Hopefully not, but that's gonna be the focus here. And there's a lot to break down. It's all seemingly kind of intertangled.
Awesome.
Yo.
We're really excited. Oh, Sam, please. I'm going to stop talking.
No, you're good, Q. I was going to say, hey, and that pretty crazy. I missed last week completely. I was on vacation and I pretty much had no service for the entire week. So probably a net good thing at the end of the day. But been diving into a lot of the contagion stuff as of late with price, with equities, legacy markets, crypto markets. So pretty exciting few days back.
And we're also joined by none other than CK Snarks. How goes it, CK?
It goes well, man. I'm hyped to be calling in from the studio once again back on Bitcoin Magazine Pro. Want to give a shout out to everyone tuning in on Spaces. You can go to Bitcoin Magazine's YouTube page and see all of our beautiful faces, maybe even some charts as we break all of this stuff down. Also, want to give a quick shill to BitNext and tell them thank you for supporting Bitcoin Magazine Pro. But yeah, I mean, life is good for a humble stacker. Sats are on discount, and it looks like that might continue as the contagion, if you will, within the crypto ecosystem is far spread.
Yeah, I think we'll definitely dive more into it as we go. But I just think that the biggest thing on my mind through all this is the irony that the thing that Bitcoin was somewhat designed or invented or created to stop bank rehypothecation, asset rehypothecation, bank lending bubbles is the exact same reason why the Bitcoin exchange rate has tanked by 50% over the last couple of weeks and is down 80% from the highs. It's that we have more than I apparently thought, just a vast amount, billions of dollars of unsecured debt out there. And these dollar promises, or whether it's Bitcoin denominated or dollar denominated liabilities that were other people's supposed assets, other institution, other firms like Voyager, is just gone in one poof. And so it blows my mind that when you have a transparent ledger of ownership with the Bitcoin UTXO set, or even stable coins, which are able to be viewed on a ledger, you still have unsecured lending going on. It's somewhat mind-blowing, just how irresponsible some of these risks that firms like Voyager and many of the lending platforms were taking, as well as the Three Arrows of the world. But for someone that's interested in accumulating Bitcoin, it's obviously a good thing over the long term. But over the short term, there's some pain, and I think we probably haven't got to the bottom of it, in my opinion.
Let's just for Sam's sake, because he was off the grid and living under a rock last week, quickly catch up. Dylan, I mean, you were on a tear, putting out articles for BM Pro, putting out Twitter threads nonstop, really breaking down both Celsius. And then we're still witnessing this unwind of Three Arrows. It has not really, in my understanding at least, come to fruition, but you have been really on them in particular. Do you mind just giving a quick overview of what you saw? This is all for Sam's benefit, by the way.
Yeah, I think it all starts with the Luna UST blow up. I put out a thread. I pinned it at the top of the Nest. It's pinned to my homepage on Twitter. Just about, it was, and at the time it was hypothetical or speculative about the contagion that was potentially going to take place due to just not so much even the Luna blow up, but the UST blow up. And obviously they were interlinked, but the fact that there was, $18 billion of stable coins out there that weren't money good and actually just went to zero. So I kind of it was more of a speculation that there was going to be a lot of desks, there was going to be a lot of funds, there was going to be a lot of potentially insolvent counterparties out there, and that the impairment was going to kind of wreak some havoc. And a month later, we saw not only with the Luna debacle, but you saw like with the whole staked ETH kind of derivative complex, which is another, you know, rabbit hole to dig down that I spent my last kind of month learning about. You saw Celsius really narrowly escape the Luna UST debacle. And you could see that on chain. And Celsius was kind of in the middle of this unwind in the staked ETH derivative as that one-way redemption started to, that peg, which isn't a peg, but that one-way redemption from ETH to stake ETH started to break, and it's trading around 94 cents to the dollar at the moment. And so when you have, you know, Celsius or, you know, counterparties that are doing this to generate yield through these elaborate kind of DeFi strategies, and you see that exchange rates start to break, well, there's some questions, which is why I was, you know, pretty loud about Celsius in particular. As it turns out, you also had Three Arrows that was impaired by the Luna UST debacle, had a bunch of staked Ethereum, and really there's not enough liquidity to turn that back into ETH. It's similar to kind of the GBTC mechanism where Bitcoin's very liquid, GBTC is not, and when that premium turned into a discount, it was even more illiquid. There's not really many buyers for it. So similar, staked ETH was also kind of like that. And so you saw Three Arrows at the same time that Suzu was tweeting about how staked ETH was so very innovative. Three Arrows was funneling money to try to get back liquid as they were allegedly and obviously now confirmed to be insolvent. So, you know, there's obviously worries about BlockFi, worries about Voyager. You could see on Voyager's quarterly report that there was, you know, they lended $320 million to counterparty B in Singapore. Now we kind of know that was actually Three Arrows Capital. And funny enough, counterparty A from the Virgin Islands was also, it looks to be Three Arrows Capital. If you sum up the BTC lent and the USDC lent at the time of the closure of the first quarter, it adds up to about $1 billion, which is identical to the amount that they lent out to those two counterparties based in locations where Three Arrows Capital resided. So a whole lot of shenanigans going on, and obviously the FTX SBF bailout or somewhat of a bailout credit line is helpful, but it really is just kind of kind of plugs the gap. It doesn't really change any of the structural issues here, which is that all of these lenders are interlinked, and I guess because of these unsecured liabilities, you have this daisy chain of defaults. So I think I'm of the opinion that for the health of the industry, it would be best for it to all be purged. I'm not rooting for anyone to get liquidated by any means, but this is a structural problem for the Bitcoin exchange rate. The Bitcoin protocol is unaffected, but all this debt needs to be purged.
Sam, do you feel like you're caught up enough to comment on this?
Yeah, I would say so. I guess I'll just comment on like more these yield generating shops, kind of lending shops out there right now where people are posting, whether it's Bitcoin or other crypto assets in general. I think the biggest critique about them for the longest time is just like the level of transparency that's not there in terms of, quotes, the yield that you're getting in some of these. And so it used to be, back when the GBTC premium was so high, that was such a popular trade and such a high yield trade early on for a lot of these shops. And it was necessarily more of like a safer market making trade, but that didn't last for a long time. And that kind of diminished. And you can see some of this in loan books. Genesis Trading is a good company that does a lot of the market making behind this and loaning out to institutional fund shops and things like that. Kind of in their loan books and in their demands, a lot of companies started going to more of the Ethereum DeFi kind of yield staking type opportunities out there to be able to generate that. So I think that's necessarily like a sign right there that, a lot of these customers demanded this. And then a lot of these companies had to go find this yield and take on more risky practices. And obviously that has shown up in Celsius first being the most risky one of them all. But at the end of the day, I think, what this whole process has lacked, and hopefully through some of these yield generations, because I don't think that's going to go away. I think people are going to still want to find some yield on their collateral in some way. And these shops are going to exist. Obviously, the ones that are the most risk exposed and exposed to liquidity now is, I think, the big move are going to get exposed and they're going to collapse. But essentially now I think a bigger part of this too is that you have this 3 Hours Capital going under, and I think they have 18 billion at peak in terms of what was under the fund, whether how much that was their kind of like own capital investors or what they were getting loaned out. Now that takes away a lot of the liquidity in the space too that was there, and that's where you kind of see FTX come in and say, okay, well, we can kind of push through some of that liquidity in the short term. And so it's hard to say a company like Voyager or BlockFi obviously both had some exposure to this. I think in Voyager's like recent release on the 12th, they said that they didn't have any essentially exposure to DeFi or to lending or to ST but by having exposure to 3 Hours Capital, they obviously did, and their book was almost 8x in lending in like 6 months over that time when that GBTC premium got pretty crushed. So I think just getting that release today and showing you that, it's kind of FTX and, Sam Bankman-Fried to the rescue here with Alameda Research as well, that, those companies are looking for opportunities to essentially accumulate in a different way. They already have a pretty big stake in Voyager. And so it's hard to say, if this bailout, what it essentially is, a revolving line of credit, is going to keep these companies solvent enough as they try to grow and ramp into a new retail growth. But I think, this is going to be one of the tough parts of that. Essentially just doesn't solve the transparency of these loans and the lending activities that are on these platforms as they are. I know if you look at someone like Ledin, Bitcoin focused company, they have something like a proof of reserves that gets you a little closer to that. And you can read through some of the Genesis reports in terms of the partners they're lending out to and why, but still doesn't get to like that transparency of what's like really needed to understand that this is actual yield that's being generated in these shops. And I think most users are just taking on risk that they probably don't fully understand or not compensated for.
It sounds a lot like, oh, sorry, Dylan, go ahead.
You got it, Q. Fire it away, man.
Well, the way I'm sort of understanding a lot of what you guys have said is essentially like there was a really fun dance going on and everyone thought that the music was just going to play forever, and we're reaping the sort of the result of the music turning off, and a lot of people are just standing there like, wait a minute, this system I thought I could just piggyback off of, if you will, forever, it's not a viable or realistic system. We're seeing various ways that these yield offerings platforms are getting crushed. Walk us through, in your own words, why they thought it would work and why it just can't work.
Well, yeah, I mean, I think ultimately a lot of the crypto yield that, the yield products, it's not yield. First off, what you're doing is you're selling the long tail volatility. It's like I use a reference, like a lot of these yield shops, it's like selling far out of the money S&P put options. You collect a premium, your account balance grows, but ultimately some 3-4 sigma move comes and wipes out your entire portfolio. That's what you're doing when you're depositing your Bitcoin, and specifically Bitcoin. Like I think USDC yield is somewhat different. And still it shouldn't make sense that you're getting an 8% yield on some of these platforms when the treasury yield is 3%. Like there's inherent risk there. That's the first thing. But I think that's really important to understand, right? Like in 2021 you saw the explosion of all of these yield products, but it was for a reason, right? It was because Bitcoin went parabolic. So did a lot of these like altcoins too. And on these derivative platforms, also with the rise of DeFi, there was so much demand for leverage, and there was so much demand to speculatively like long Bitcoin and other crypto assets that you could actually generate, and also the GBTC arbitrage, you could generate a huge amount of delta neutral yield. Delta neutral meaning you don't have exposure to the upside or downside of Bitcoin. You're just harvesting an arbitrage. So it would be selling futures, longing spot. You have no exposure to Bitcoin, the asset, but you're getting at the top of the bubble. It was like a 40% annualized yield. On perpetual futures, it's obviously a variable rate, but you could, for weeks at a time, get a 50 to 100% yield just because of how leveraged long the entire system was. So obviously that's all gone. There's nearly no contango futures price over spot. The premium or that spread on an annualized basis is like 2 to 3 to 4% maybe. So that's gone. The GBTC premium is now a GBTC discount, and it's a one-way redemption structure. So you can't take the GBTC and get your Bitcoin back. That's trading at a 30% discount. So all of these yields that the BlockFis of the world, the Celsius of the world, basically had to arbitrage and to pay these yields disappeared. And at the same time, because of how well these products worked at the time, because they could harvest these arbitrage opportunities, the platform's asset under management grew by a lot. So the BlockFis of the world, Celsius, Voyager, I don't have exact numbers in front of me, but I know for sure that their assets under management in USD and BTC terms increased from the beginning of 2020 to say the start of 2022. There's no doubt about that. And you saw midway through the bull market, like the BlockFis of the world, they started to lower those yields that they offered because they realized it was never sustainable. BlockFi also had their income statements leaked from the last 2 years. They lost money in 2020 and 2021. So again, I'm not here to bash any business. I'm not saying, I'm not trying to start a bank run. I've been accused as being a fear monger, but you have to understand that the risk reward of holding specifically your Bitcoin on these exchanges for a 1 to 2% Bitcoin denominated yield is just so not worth it. And it really never was. So if you got your yield from BlockFi for the last 2 years, great. But I would highly recommend you withdraw because it seems like a lot of these businesses, like a yield or a loan from SBF and FTX doesn't really change anything. I think really probably Voyager ends up being owned, the equity ends up being owned by FTX just due to where creditors stand in the capital structure. So does FTX just take a big hit and kind of make all these depositors whole? Maybe. But if not for that, then the Voyager of the world, they're structurally insolvent. And I don't know how many other of these kind of bucket shops are out there, for lack of a better term, but none of them are safe. That's just, I would say, a fact by now. And I wouldn't leave it up to chance.
Just a quick little hit list of other platforms that offer you yield on Bitcoin or other crypto: Gemini, Coinbase, as Dylan mentioned, BlockFi. I believe we were talking this morning at the beginning of the stream, Chris, about what was it? OKCoin. I know that we were talking a little bit. Prime Trust. Prime Trust was the bank. They supply both Swan as well as Strike, but they have a plethora of other exchanges that do actually offer yields. I know that Odell was the one tweeting out about the Prime Trust stuff, and I'm sure, Dylan, it'll be on your radar if it's not already soon enough. I wonder, why? I mean, I kind of know why, but I want your guys' opinion on this bailout that Sam Bankman-Fried has essentially offered to BlockFi, and why it's even necessary, and why should BlockFi not fail? Or why, in your opinions, should BlockFi fail?
Yeah, I mean, it's overall bad for the industry, if you want to call it that, for these, the Celsius, these platforms to collapse. That's not a good thing. It's a stain on the industry, on Bitcoin. Even if Bitcoin is an apolitical neutral protocol, it's just not a good look. So I would say that's the first thing. And you saw SBF comment something similar to those lines, like, we have an interest in stopping the contagion. One is probably just due to the fact that if the market's 95% off the highs, it's not good for the FTX business model. And the higher that the Bitcoin price is, the more interest they have in their platform, the more fees they make. So they have a vested interest in keeping the market somewhat propped up, right? They're definitely going to probably lose some money on these agreements because a loan to an insolvent corporation like a Voyager per se, who was taking customer funds and lending them out unsecured to hedge funds, Three Arrows, which ultimately is not money good. More interest, more loans doesn't actually help that platform at all. So it's probably just going to be a restructuring deal where FTX eats the difference. So maybe there's some brand value or intangibles for the BlockFis of the world. So that's certainly part of it. Customer acquisitions. Maybe it's BlockFi brought to you by FTX in a year. I'm not sure ultimately, but I would say that it's probably in big players' interest to stem this kind of industry-wide contagion we've seen. Whether this is the end of it or not, or more dead bodies float to shore, I have my, I have my doubts. I don't think this is over. But I would also like to just, distinguish between Bitcoin denominated yields or say other crypto assets versus the native protocol yields that some of these altcoin shitcoins spin off. That's just really just paid with emissions or paid with kind of the inflation of the token itself. So like ETH 2.0, if it ever becomes a thing, which it probably will, they're paying you, you're getting yield for staking built off, spun off from the protocol. There's no way that can work with a proof of work network with an absolutely scarce asset like Bitcoin, which is why Bitcoin denominated yield there's always inherent risk there. It's never, they have to do something with those coins. So I think that's just an important to distinguish, right? Is some of these altcoins, they have their altcoin denominated yield that they pay for through the token emission or through, a bunch of other kind of elaborate schemes. But with Bitcoin, there's no way to actually harvest or generate yield in a risk-free way, which is often misunderstood from my experience.
Yeah, well, I was going to say it's partially misunderstood because one, there's yield in the traditional banking system that people are pretty familiar with without actually having a really strong understanding of it. But two, crypto marketing has really ran with this idea of yield and gone hard to the paint with it, when the reality is that none of these things are actually delivering yield based on the original definition, right? So if anything, it's a very different type of a trade that people are unintentionally or unknowingly kind of getting themselves into because they're used to this idea of like, I deposit money and I get interest.
Yeah, I mean, to add on to CK's point, I mean, it's not something that in the future you think of like something that's more closely related to Bitcoin and you have more productive yield that's, Bitcoin being loaned out and being returned with kind of like Bitcoin alpha generated there. It's also just like a period of like euphoria and greed and speculation. The idea that, people are going to go generate an extra percent yield on assets that have been going up thousands of percent over the last couple of years too, is just kind of maybe the ridiculous phase of whether you call it the top or the speculative cycle that we're in. But going back to Q's original questions, I think Dylan said it well, like why does FTX stand to benefit from essentially taking on lines of credit here and taking on more of the debt cap table of these companies? I mean, they already have 11% share and voting rights in Voyager. So I think there's incentive there, obviously, to try to keep the business afloat. But I think broadly it goes to that, that this is bad for the space. The more kind of bucket shops or yield generating shops that go under, especially the size of BlockFi and Voyager, they're probably in those top 5 yield generating kind of exchange spaces by size, by customer assets and platform. I think Voyager has over 5.8 billion. And half of that in their statements was essentially out in some of these more risky activities. So having one of those shops go under again, like Celsius did, just hurts the entire space, would essentially hurt kind of customer growth and acquisition and demand for the space as well. And all 3 of these companies, I mean, FTX obviously much better off in what they've been able to build and a lot different than this, although they do offer some yield generation, is that they're all at a kind of pivotal time where everyone is trying to grow retail customers and kind of more, quotes, crypto adoption and getting more people in the door. It's essentially like their business models are built on that, of taking losses over the last few years to the bull market so that they can kind of scale up retail customer acquisition so that they can eventually make enough money. So any one of these shops going under just increases the regulation scrutiny that's already coming, and kind of just deflates more of the demand for kind of retail growth over the next year to join in on these shops and to continue that. So, I mean, making these things, whether ride for another year or whether they fold under FTX, obviously it's probably an interesting acquisition strategy for them to just get more roots in the space, if they're going into more of yield generation or other lines of business. But I think overall, it's just, you don't want to see the entire space go under any more than it is, because it just affects everyone's business at that point.
I would love to like jump in and ask you two about your opinions on really the rise of FTX over the past 3 or 4, I guess it's like 2 or 3 years. And, no matter, what you think of the actual product or products, it seems that they found ways to weave their tentacles very successfully into almost every aspect of this industry, and even to players that were traditionally not even part of the crypto industry, like Robinhood. I saw that SBF bought the dip on their publicly traded stock and now has a large share of that as well. So I guess, what are your takes on the company FTX, the leader that is Sam Bankman-Fried, and all the products that they're kind of building under them?
Yeah, I mean, certainly I've used FTX. It's a solid platform. I think the rise and the kind of the growth of the company is good. Obviously, there's it's not Bitcoin only. None of the crypto exchanges are. I think that's just a pure incentives thing. So it obviously makes sense. I think they just rose because they offer a superior product. They have global derivative suites, like similar to Binance, which allowed them to grow on market share from, say, the Coinbases of the world, which are spot only. Also, the liquidation engine compared to that of certain exchanges is pretty good. They allow cross collateralization, which is good for traders and optionality. But I would say it's part of the reason that we're in this, and not to blame FTX, because I think this is just a symptom of the whole crypto industry as in general. But that cross collateralization of Bitcoin and altcoins is part of the reason that we're here in the first place. It's part of the reason that Luna blows up. Altcoins get massacred and Bitcoin falls. It's because it's all kind of cross collateralized against each other. So I mean, the product is pretty solid, I will say, and I think future, kind of the futuristic vision of like a financial service company that allows you to have Bitcoin, borrow against it as collateral, or peer-to-peer lend, borrow. Like you can borrow or lend dollars on FTX, but it's not rehypothecated. It's directly peer-to-peer, similar to how like some open interest contracts work on other derivative exchanges. So I think that's solid. They're not the one that's lending. It's completely peer-to-peer. So I think that's pretty cool, I guess. What else? Yeah, I mean, it's similar to kind of like Arthur Hayes and BitMEX. They have a trading prop desk, which supposedly is not affiliated with Alameda, but there's definitely some liquidation hunting going on. So we can discuss the merits of that. But, overall, I think FTX probably transitions or kind of merges with the legacy institutions and starts to offer equities and other assets and kind of emerges as a do-all brokerage probably a few years out. So that's exciting. I think Bitcoin kind of integrating with the legacy system more and more with equities, bonds, et cetera, is a good step. But I think that's probably all I have to say in terms of the company.
Yeah, I would just add, I mean, to Dylan's point, I mean, overall, I think net positive thing for the space. I think, with FTX's background of just saying, how can we come in and basically all of the perpetual funding exchange products on the market at the time, and just saying, how can we build something much better product for the users at that space and be innovative and kind of execute on that and have kind of better capital management and risk management and the growth that they've done today. Apparently, right now we can see them as kind of like rising as this almost like Amazon of the space, where they're going to branch out and try to a lot of different business lines, whether that's in the Bitcoin space, the crypto space, the traditional finance world. They're just going to continue to like try to branch out and break down some of these middlemen and kind of fill some of those efficiency and kind of innovation gaps there. So you mentioned Robinhood. I think within one Robinhood trade, Sam Bankman-Fried was talking about that, there's essentially 10 middlemen or counterparties within that, essentially. So being a company that can come in and maybe take that essentially very low counterparty risk that's in the nature of the broader crypto space that we see today, at least a lot less risk, a lot less counterparties, shouldn't say level of risk, but a lot less counterparties that are in some of these traditional finance markets, and maybe try to innovate there and create some more efficiencies. Probably a net positive thing. Probably with Dylan of the opinion that I don't necessarily think that these bailouts or revolving line of credits by FTX, they're going to make FTX larger for sure, that they're necessarily good things. But at the end of the day, it's, kind of a free market in that world. And they they've at least tried to be pretty proactive and be a space that is not going to like stay in the industry overall. And I think they've put a lot of thought into trying to make sure that you don't have something like this where companies go under that's going to make things worse. So overall, definitely becoming a behemoth. Probably some issues with that down the road, but I think kind of just free market activity that's playing out, and servicing demand for what people want at least.
Talk to us a little bit about maybe what your expectations are, or where you guys are looking for maybe the next unwind. I know Three Arrows, 3AC has been at the forefront of a lot of your conversations. Dylan, what or why is that maybe the next, I don't want to say target necessarily, but the next domino to fall?
Yeah. I mean, I unfortunately don't think we're at a bottom. I think that a lot of the or the collateralized debt on DeFi, that the Celsius of the world, and there's still a lot out there. Transparent liquidations. Just from talking to some institutional traders, obviously everybody understands the broader risk-off macro regime, dollar soaring higher, risk-off environment. Whether we're in a bear market rally for equities is I think we are, but probably that turns over at some point. And so just from talking to a lot of these the big money traders, even just like retail, there's not really an interest in stepping in here and buying, while there's still over leveraged players that are gonna become, if we get to these levels, for sellers. So whether that's 17K, 16K, 15K, 14K, it could just be a wick. But just off Bitcoin's past, these bottoms are usually marked by an utter liquidation of all mark-to-market debt. And that can include, Ethereum and some of these altcoins, right? Celsius is still sitting on 400,000 staked ETH that they borrowed dollars against. So staked ETH is relatively illiquid. You have the curve pool that is a majority Ethereum, or a majority staked ETH, and only 20% Ethereum. So there's not really any exit liquidity there. There's a big target on their back. And so I think maybe not just Celsius, but there's a whole bunch of debt out there that's probably gonna get liquidated. I mean, I've been nibbling at some buys, but I don't think this is all resolved until we see another flush out. Either that, or it takes a lot of chop and consolidation to get to the other side of this. But just based off of kind of the bond market, based off the consumer, based off what the Fed is saying, they're literally telling you that they want lower asset prices to stifle demand. I don't know if we bottomed. So I don't know what fund or firm is next. I'm not trying to be some bounty hunter. Like that's not my incentive. I have no incentive. Actually, I have like the opposite incentive. I have exposure to Bitcoin, quite a lot of it. Like I don't necessarily want it to go down, but I think that's just the reality of the situation that we face. There's just a whole bunch of overexposed underwater players, from DeFi collateralized loans to also like say Bitcoin miners who are getting their margins really squeezed with hash price nearing all-time lows, that have a whole bunch of collateralized debt. So therefore sellers, and I think just based on how bad this recession might be, there's going to be a lot of other for sellers too. So I think the big money bids underneath that, but I guess we'll have to wait and see. Nothing's for certain. I certainly don't have all the answers.
Hey man, I've been taking my trading cues from Pete Rizzo for some time, and it's actually been very lucrative. I highly recommend you give him a follow. But you touched on, when I asked about like why would Sam Bankman-Fried want to even bail out BlockFi, that they have him being such a big player and a big bag holder, he has incentive to keep the dance going, if you will. You also allude to the fact that while you may not necessarily be the level of a bag holder, someone like Sam Bankman-Fried or just any of these exchanges, you still have an incentive to see Bitcoin not crater down and want to see it go up. Is there a middle ground where some sort of a leverage or debt position can exist in a healthy Bitcoin ecosystem, in your opinion?
Yeah, I mean, totally. I don't want to steal the show here, and certainly want to hear Sam's thoughts. But I mean, I've spoken out and said, in certain situations, Bitcoin collateralized debt, especially for someone that's all in, if done responsibly, is totally an option if you don't want to pay capital gains or whatnot. Obviously, the lower the price goes, the more the safer you are. Certainly, you don't want to take your entire stack of Bitcoin at 60K and collateralize it, with a 50% loan to value and get liquidated at 30,000. That's not optimal. But I would say, honestly, I'm waiting for the Fed to get easing again before doing some of these strategies. And obviously, there's counterparty risk. Companies like OnChain Capital, not affiliated with them, but they when you deposit Bitcoin as collateral for against dollar denominated debt, they give you a key out of the one of three multi-sig. And so you can watch your Bitcoin and know that it's not moving and know that's not rehypothecated. That's certainly attractive. But I wouldn't want to be opening up market debt positions now. But certainly, whether it's lower prices or just, a Fed pivot or, just the chart looks a little better. I think collateralized debt against your Bitcoin is certainly it's profitable over the long run to short fiat. The only problem is, or maybe not problem, but the reality is that the dollar has these kind of strengthening cycles where if you're short the dollar, you get quite wrecked. So there is a little bit of timing there, but over the long term, I have an interest in shorting the dollar and longing Bitcoin. It's just a matter of doing it right and doing it where you never become a forced seller, which is obviously takes some positioning and a little bit of skill and luck.
Yeah, and I'd probably say for the majority of people, it's not even useful in the sense that you need to be able to manage risk profiles, liquidation, kind of thresholds that you're willing to take. You need to be able to understand, if you took out massive loans of Bitcoin at 40,000 and now you're topping that up, you're in a dangerous position where you are now. So I think people realizing that if you're going to do it, for the majority of people, it makes sense for a small amount of positions. But I think for the majority, taking that on probably doesn't make a lot of sense in the assets there. Just from my view, I don't know if the risk reward is there or people quite understand what that is. But generally, for someone like me, I'd be willing to do it at a small kind of good entry point, and am looking for opportunities to do it here. Absolutely. And then just in terms of the space overall where kind of debt is going and leverage is going, it's just kind of one of those violent 24/7 free markets that just kind of breeds off that pretty much, the perpetual funding market being most of the volume that's traded within Bitcoin. I don't think that's ever going to go away. It's probably going to smooth down and maybe get less volatile over time as the asset grows and things get a little bit more sophisticated. But I think that's just kind of the nature of the system in terms of kind of violent leverage when you're only a 700 billion or maybe 500 billion market cap, whatever it is now, and kind of open 24/7 and probably the only true free market out there.
I think there's also something to be said about your position size relative to what you're trying to do. If you have $10,000 of Bitcoin, it legitimately makes no sense to go put that up and borrow against it. And whether you're buying more Bitcoin or trying to finance something, it just doesn't really make sense. But if you have if you're an early Bitcoiner or whatever the case may be, and have a large stack of Bitcoin that maybe isn't all of your assets, or you can pledge just 2% of it as collateral to finance your lifestyle or to make another investment or do whatever, that's probably a pretty reasonable thing to do, especially as I believe that over time these Bitcoin collateralized solutions, given say a 2-to-1 or maybe 4-to-1 over collateralization, I think that rate similar to say a Charles Schwab, when you can borrow at Fed funds plus 50 basis points. I think Bitcoin collateralized loans with established firms over collateralized loans will be some of the lowest rates that you can get. It's just a fact that over collateralized Bitcoin is better and more attractive for a lender than a mortgage or some of these other collateral types than a car, right? And so for that reason, obviously people will cite the volatility, but that's the entire point of over collateralization. If I pledge $40,000 of Bitcoin and then borrow 10,000, the price can drop by 75% before I get margin called. And so I just think that, when taking this into account, if you don't have like a ginormous stack or a pretty reasonable sized amount of Bitcoin, it's better for you to just stack sats in cold storage, avoid all mark to market leverage, and just forget about it. But for someone with a pretty large position that understands the risks and the trade offs, then sure, just never become a forced seller. That's the number one rule.
I want to ask a question that's going to piss you guys off. And before you get upset over it, I'm sorry. But let's talk a little bit about this inevitable bottom, because there will be a bottom of this bear market and then a new bull run. My thesis so far out the door at 28K, I'm a moron. My second thesis of no way in hell will break the previous cycle's all-time high, thrown out the fucking door. Is there some sort of a calculation or expectation on where you guys are eyeing, maybe some tips on where your limit orders are currently set up at?
Yeah, I mean, not really. Waiting just for, I think the legacy markets continue to melt down. I mean, I snagged spot Bitcoin. I mean, I posted it transparently on Twitter. I snagged a Bitcoin at 17.8. Pretty fully hedged, margin short Ethereum. Been on and off for a while, so feeling okay about that. I would just say, whether anyone that's telling you they know where a bottom is probably lying to you, or just supremely overconfident. There's obviously the crypto leverage risk. The Dixie probably goes to 120 this cycle. The VIX is probably explodes before all said and done. And consumer confidence is at all-time lows. The reality is people don't really have a lot of money. Retail doesn't have the money. Institutions aren't really interested in going on the furthest out on the risk curve. Right? Never mind the fact that like Bitcoiners will say it's a risk-free asset, it's a unit of account, 1 BTC equals 1 BTC. I agree with a lot of that over the long term. Over the short term, no one's really interested in YOLOing into an 80 vol asset, as we're in a system-wide deleveraging in the legacy markets. So how low that goes, I'm not sure. I certainly am going to be interested in the mid-teens, but really looking to the derivative market, perpetual swaps for sure, to see a sustained period of negative funding, or in the quarterly futures market, backwardation, showing that most of that spot selling has potentially taken place, and all that derivatives and all that leverage is actually betting on the price to go lower and not higher. It's the opposite of what you see at tops. So where that is, how long it takes, is anyone's guess. You can certainly stack here, and it's a great place to do it. But also, I mean, I would say save a little bit of dry powder. Sam and I kind of had a framework of realized price, kind of that average cost basis of Bitcoin, and the 200-week moving average as these really, really long-term attractive entry points for a bottom, or for a bear market entry point. We've been kind of saying that since the fall, which was around 25K, 20K. Those hit, but I just don't think, with all of this stuff playing out, the contagion that we've been talking about and writing about for the last 2 weeks, really doesn't make sense to call a bottom at any level with supreme confidence. And for a sat stacker, this is an absolute dream. For someone that's trading this or is interested in just a speculation during a bull market, then right now may not be the best time for you.
Yeah, that was really well said. I'll just add, I mean, Dylan been talking about this. There's a lot of different angles to look at it. I think what Dylan mentioned in terms of just having this kind of on-chain benchmark of this, one, realized price, and then we've talked about breaking that realized price network up into long-term holders and short-term holders. Now that long-term holder realized price around there is kind of 22.5, right around there, kind of right at the cost basis. So that was been a guiding kind of metric for a while to say, okay, well, we want to see kind of the capitulation events before in Bitcoin's history. And it's, very small sample size of data to look back at capitulation events. See a lot of price go below that. And I think it's a good reason, real capitulation events people have been holding the asset for a while need to kind of feel some pain in a lot of these forced sell-offs and drawdowns, especially, we're in a pretty unique economic territory that we're in now, kind of real turning point that I don't think we were in any of these previous cycles. So I think for the first time, we felt some like of that capitulation type pain. We didn't necessarily see some of the over shorting behavior, like Dylan mentioned, in the perpetual futures market that we've seen before, which is a good indication of people just like shorting Bitcoin into the dirt, into its bottom, kind of a sentiment change about, that it's too low. Obviously, like the crypto kind of contagion fears that are out there. I think for a while too, from January, we've been saying like a big piece in the legacy markets as well is just, one, you kind of got to watch this bottom, like see more of like a durable equities bottom. And we've seen like a lot of bear market rallies. I hate posting this chart I've been putting together a few times. Is just kind of like the S&P drawdowns compared to like the '08 crisis and the 2000 .com bubble, and just the violent nature, kind of like zigzagging of these bear market rallies in this down channel that happens. Not necessarily, to spark fear, but just to say that like based on a lot of metrics, it just seems like the S&P's got a lot further to go, and it's hard to see Bitcoin bottom or do better without inequities kind of bear market being over. So kind of never seen that before. So those are some things we're looking for. Also, just kind of in the legacy financial markets. Obviously we've seen contagion spread through maybe more the crypto markets, but still haven't seen maybe levels of blowups there that potentially on the horizon that we could see. Still look at something like the volatility index, the VIX, they have the S&P, and like credit volatility. Still haven't seen those blow out, or credit spreads blow out like we've previously seen. So some of those like the legacy market stuff that we're watching. And then from like an on-chain perspective, some of the things I posted just a thread earlier yesterday on some of the charts I like to look at, just to let you know, like in terms of capitulation and what people sitting in unrealized losses, that this can happen for a long time. It can happen for a couple of months, a few months. It can be sustained. So we kind of have this one, what feels like capitulation event, maybe a small decent chance that that's the bottom in my view. But I think that generally people feeling more pain for like a prolonged period of time and seeing how they react to that would give me a little bit more confidence in where it bottoms up.
So I have one final question for you all before we wrap this one up. The question kind of revolves around Bitcoin's place in the overall market, right? We saw with March of 2020 that Bitcoin deleveraged faster than all traditional assets, and then Bitcoin, bounced back harder and faster than all traditional assets. A lot of people are, saying that Bitcoin is going to lead the market once again here, and that the fact that there are no bailouts in the Bitcoin market other than, I guess maybe FTX and private market bailouts, that this will help, kind of Bitcoin be a better signal for what's actually happening in the economy. Dylan, why don't you start? But, what's your take on, Bitcoin as a greater signal for market health or lack of health?
Yeah, I think there's certainly something there. We saw Bitcoin top out before equities and the bond market the credit market started to really scream in November. Like the top was right around when Powell came out and said we need to do something about this not so transitory inflation. So I think that's interesting. Is Bitcoin? I've kind of had a thesis since 2021 as Bitcoin's like the most pure signal of credit contraction or credit expansion in the legacy system, or at least it's growing into that. And so it makes sense during a period where the central bank's unwinding its balance, it's kind of pulling that capital in. It's instead of money printer to go burr, it's like money printer go like whir, and it's pulling all that money back in. It makes sense that Bitcoin's exchange rate is declining. But also, 24/7, 365 mark-to-market leverage is being liquidated, and all of that collateral. There's, unlike a house or unlike some of these say equities or bonds that have circuit breakers and have market hours. Bitcoin trades 24/7, 365, and is certainly in the process of a pretty rapid deleveraging. Right, 50% down from 10 days ago. So, I mean, that's my base case is Bitcoin bottoms first. We're going to see whether we've seen the worst of the contagion and capitulation or not. I think we probably get a wick lower, and I think more pain comes to Bitcoin. And similar to last mini bear market in 2020, with the Fed coming in. I don't know if the Fed comes in right away, but I honestly don't think they do. But Bitcoin had recovered 40% from its bottom by the time that the equities bottomed 10 days later. So I kind of view it in a similar light, where we have all this mark-to-market leverage. You have all these off-balance sheet assets and liabilities that are just disappearing, like Voyager. And so there's pain. We're seeing Bitcoin sell off as a result. But I think just due to the kind of the 365 nature of Bitcoin, 24/7 nature rather, that we will see a bottom, and Bitcoin delevers first. And once the Fed comes out or Powell comes out and says some obscure speech that they need to finance the treasury market or stabilize this, that, or the other thing, I think that's when Bitcoin absolutely flies. Just because people understand that this end game is more debasement and more printing. So I think if that answers your question, I think so.
Yeah, hard to top that. I would just add, my own thoughts. I see Bitcoin as just like this liquidity kind of sponge or vacuum, almost like when the liquidity is on, it's taken it first, and it's taken as much as it can get. And when it's been turned off, like it's been turned off over the last 3 or 4 months, and that liquidity is getting contracted, and there's more of a dollar rush here in the environment. And today, it's getting pulled out extremely fast. And I think that's just because of where Bitcoin is at today and how it's thought of in the markets. It's still one of those things that's finding its place, even though we might see it as this decentralized kind of superior money that's on the horizon with a vast amount of use cases. It's still on that just far end of the risk spectrum overall. So I think ultimately what you're looking for is hate to always bring up the Fed in terms of whether it's they're managing expectations of the markets or the market's reacting to that. It's really, a bigger part about central bank liquidity and liquidity in markets that's going to probably change the tides for Bitcoin. Maybe that's towards the end of this year. We're already starting to see a little bit of kind of Fed pivot in rates that's coming in. And really just at the end of the day, where some of these central banks have to go back and turn on the liquidity so that we have functioning markets. And when that happens and there's more excess in the system, I think that's when we'll start to see another rise in Bitcoin, but that certainly could take some time.
Well said, guys. And I just want to quickly shout out to everyone who is watching both on YouTube as well as over on Twitter Spaces. If you are enjoying this analysis, you are enjoying what Sam and Dylan have to say in their perspective, there's no reason you should not be subscribed to the free version of Bitcoin Magazine Pro, where Dylan and Sam break down everything that they're seeing in the markets. We've pinned a link to the top. We've sent out links on the chat. We'll make sure to include it in the description as well. Dylan, Sam, I'll let you two maybe share a little bit more about what you guys are cooking up with the BM Pro product.
Yeah, we like to cover a little bit of everything. I mean, obviously the contents of this show, talk about Bitcoin markets, increasingly the crypto complex, although that's not our focus. We just cover it because it obviously relates to Bitcoin, the asset, and its price action. Cover Bitcoin mining, macro backdrop, derivatives on chain. We like to cover it all. Just to kind of give people a view of what's happening and why, and we do it with some pretty good visuals, we think. So that's us. That's what we do. Appreciate everyone tuning in. And we will, I think Sam and I are in the works of putting together a detailed report of this Contagion mess. So I think that'll be released Tuesday of next week. So subscribe and tune in if you want to get a peek of that first.
If you're not following these two on Twitter, you absolutely should be. They are truly two of the smartest people. I learn more from reading Dylan's tweets, even his trolling tweets, than I do from any conversation I have with P. So if you like us, you like them more. Trust me. Also, subscribe to the free version. You already get plenty of emails, so there's no reason to just add one more email that you'll inevitably get. This one will actually give value to your life, make you a better person, and who knows, maybe help you make a little bit of Bitcoin money, whatever you want to make. So that's my my hard shell because this is my genuinely favorite newsletter and favorite email that I get. So thank you both for joining us. Thank you both for the work that you two do. That's a wrap.
Peace.